In a standard breakout setup, price compresses, volume swells, and a sharp upward movement clears a known horizontal resistance line. This specific technical location is where many intraday traders lose their funded account capital. Many traders interpret the visual scale of a vertical candlestick as a signal of unstoppable buying momentum, assuming a major expansion has officially ignited. Acting on this visual signal, they deploy maximum capital at the highest point of a vertical move to avoid missing further price extension. Frequently, the market reverses within minutes. Momentum evaporates, price drops below the entry point, and the resulting volatility liquidates the new positions. Relying on the visual shape of price action without verifying the mechanical traction underneath creates a structural trap for unprotected capital. The quantitative data suggests a different rule. A large price expansion past a previous high carries no weight if the order book fails to provide forward traction. This data visualization illustrates order book absorption. On the right, continuous market buy orders collide directly into a fixed wall of institutional limit sell orders. Traditional volume indicators can be deceptive, as they display these massive transaction spikes as signs of bullish health. A quantitative assessment focuses on net displacement. When thousands of buy contracts execute within a 5-minute window but the price fails to move higher, the total effort has yielded zero actual distance. High transaction volume concentrated within a stagnant, narrow price band represents aggressive buying pressure being perfectly neutralized. This neutralization occurs because of a supply wall, an immense concentration of passive limit sell orders placed by institutions at specific resistance levels. The electronic matching engine requires every passive limit sell to be matched by an aggressive market buy to complete a transaction. Chewing through a massive institutional wall requires a rapid sequence of market buys. This generates the historic volume extremes visible on subcharts. The price cannot advance until every passive limit order in that institutional block is filled. The ceiling remains rigid regardless of the volume spike. Many market participants misinterpret this rapid matching sequence as a bullish breakout, assuming the flurry of activity signals acceleration. In this scenario, institutional block sellers use the location to absorb available liquidity, effectively building a short position against the breakout buyers. This Duan-layered schematic illustrates kinetic exhaustion, a state where maximum effort produces zero structural reward. The activity at the supply wall mirrors a redlining engine. The engine is at peak RPM, poking at resistance with no forward progress. These locked dynamometer rollers represent the absence of net price displacement. The wheels are spinning with high torque, but the vehicle remains stationary. Aggressive market orders rely on a finite pool of capital. This buying power cannot sustain such high intensity indefinitely. The market eventually reaches a tipping point where aggressive buying fuel is depleted. The final market buy executes and the upward push stalls. An asset printing high volume without forward movement indicates a system reaching immediate mechanical failure. The primary telemetry signature for this failure is delta divergence. This occurs when the price prints a marginal new high, while the momentum histograms simultaneously print a decaying lower slope. The price moves up while the underlying thrust decreases. As soon as the aggressive buying fuel is exhausted, the institutional block seller stops absorbing orders. With the upward pressure neutralized, the institutional entity pulls their resting bids lower, removing support from the current price level. This withdrawal creates a friction-free liquidity vacuum. There are suddenly no institutional orders left to support the price. The combination of exhausted buyers at the peak and the absence of bids below creates the structural conditions for a high-velocity downward move. Risk management in this environment requires a strict velocity confirmation law. If subchart telemetry shows divergence or slippage at a major high, long exposure must be reduced to zero. DRW operators capitalize on the reversal through a tactic known as trapping the trapper, shifting into a short posture. The first requirement for this entry is observing the price rotate back into the boundaries of the morning's initial balance range. The execution trigger occurs when a 5-minute candlestick closes definitively beneath the 15-minute 8 EMA line. This micro-mean violation provides the structural proof that the breakout has failed, and the buyers who entered at the peak are now trapped. This chart setup allows for precise risk placement. The protective stop loss is positioned one tick above the absolute high of the failed breakout wick. The take-profit target is set at macro-mean reversion levels, such as the hourly 34 or 55 EMA floors. This creates mathematical asymmetry, risking a small margin at the peak to capture a macro rotation through the liquidity vacuum. The downward velocity of this move is accelerated by the forced liquidations of the traders caught in the initial trap. Maintaining a long-term edge involves looking past the visual appeal of large price candles and executing based on verified order book mechanics and telemetry.